The balance of payments, BOP, is a financial statement that summarizes a nation's economic transactions with the rest of the world over a specific period, typically a quarter or a year. It records the flow of goods, services, income, and financial assets between a country's residents and non-residents. Residents include individuals, businesses, and government entities that have a long-term economic interest in the country, even if they are temporarily located abroad. The BOP comprises three main accounts. 1. Current account. This records trade in goods and services, income, and current transfers. Goods, tangible products, e.g., cars, electronics, services, intangible products, e.g., tourism, transportation, consulting, income, earnings from investments, interest, dividends, and compensation of employees. Current transfers, unilateral transfers like remittances, foreign aid, and grants. 2. Capital account. This records capital transfers, such as debt forgiveness and migrant transfers. It is relatively small compared to the current and financial accounts. 3. Financial account. This captures cross-border flows of financial assets, foreign direct investment, FDI, investments made to gain a lasting business interest in a foreign enterprise, portfolio investment, investments in equity securities, stocks, and debt securities, bonds. Other investment includes loans, deposits, and other financial instruments. Reserve assets, changes in a country's holdings of foreign currencies, gold, and special drawing rights, SDRs. A BOP disequilibrium exists when a country's total inflows do not equal its total outflows. A BOP surplus occurs when inflows exceed outflows, while a BOP deficit arises when outflows exceed inflows. Small, manageable imbalances are normal, but large, persistent disequilibria can signal economic problems. Importance of BOP. Indicates economic health. A sustained BOP deficit may signal economic instability, declining competitiveness, or over-reliance on foreign borrowing. A surplus suggests strong international trade and investment inflows. Affects exchange rates. Persistent deficits can put downward pressure on a country's currency, leading to depreciation. Conversely, persistent surpluses can lead to currency appreciation. Influences economic policies. Governments and central banks use BOP data to formulate trade policies, fiscal measures, and monetary policies. Investor confidence. Foreign investors consider BOP trends before investing, impacting capital flows and economic growth. How governments solve BOP crises. A BOP crisis, a severe and unsustainable deficit, can arise from various factors, including overvalued exchange rates, expansionary fiscal policies, external shocks, e.g., commodity price drops, and capital flight. Governments can adopt several measures to address such crises. 1. Monetary policies. Raising interest rates to attract foreign investments, curb inflation, and stabilize the currency. Tightening credit to reduce import demand and control inflation. 2. Trade policies. Imposing tariffs or import quotas to reduce reliance on foreign goods and protect domestic industries. Promoting exports through subsidies, export guarantees, and trade promotion activities. 3. Exchange rate adjustments. Allowing or managing currency depreciation to make exports more competitive and imports more expensive. Using foreign exchange reserves to stabilize the currency and smooth out volatility. The central bank plays a key role in these interventions. 4. Fiscal measures. Reducing government spending to decrease import demand and control the fiscal deficit. Encouraging domestic production to substitute imports. 5. External financing. Seeking financial assistance from international organizations, IMF, World Bank, to bridge the deficit and rebuild reserves. These loans often come with conditionality, policy reforms, attracting foreign direct investment, FDI, and encouraging remittances. Advantages and disadvantages of a BOP crisis. Advantages. Boosts export competitiveness. Currency depreciation can make exports more attractive in global markets. Promotes import substitution. A crisis can incentivize the development of domestic industries to reduce import dependence. Potential for structural reforms. Governments may be compelled to implement necessary economic reforms for long-term sustainability. Disadvantages. Inflationary pressures. Currency depreciation increases the cost of imported goods, potentially leading to inflation. Reduced investor confidence. Economic instability can deter foreign investment and lead to capital flight. Increased debt burden. Countries may need to borrow internationally to finance a BOP deficit, increasing their external debt. Potential for economic slowdown. Contractionary policies, e.g., spending cuts, higher interest rates, can slow economic growth and increase unemployment. Impact of BOP on an economy. The BOP significantly influences various macroeconomic factors. 1. Exchange rates. Persistent deficits can lead to currency depreciation, impacting international trade competitiveness and the cost of imports. 2. Inflation. Currency depreciation and increased import costs can contribute to inflationary pressures. 3. Economic growth. A BOP surplus, driven by strong export performance and investment inflows, can support economic growth. Conversely, a persistent deficit can hinder growth. 4. Employment levels. Changes in trade patterns, influenced by the BOP, can affect employment in different sectors, particularly export-oriented and import-competing industries. 5. Foreign exchange reserves. Persistent BOP deficits can deplete foreign exchange reserves, reducing a country's ability to manage its currency and respond to future economic shocks. A well-managed BOP is essential for macroeconomic stability and sustainable economic growth. Imbalances can lead to financial vulnerabilities and require strategic interventions by the government and central bank. The central bank plays a crucial role in managing the exchange rate, foreign exchange reserves, and monetary policy in response to BOP developments.